a recovering property market, rising stocks and a higher Aussie dollar. Some interesting developments and a few positives to comment on in this month's update, despite the gloomy global backdrop. The uncharted waters of an RBA cash rate below 1% are a challenging environment in which to make bold predictions, but the latest numbers on the housing market suggest the recent rate cuts are having an impact as forecast. Peak to trough, the average price of an Australian property fell 8.5% from the late 2017 highs until June, when the RBA began its latest round of rate cuts. But since then, a third of these losses have been recovered. As the chart shows, a lot of this is being driven by Sydney and Melbourne, the two largest markets, while other cities have been far more stable and reliable, although Perth is yet to start its recovery. Regional housing prices rose on average 0.4% in October and are up 12% from 5 years ago, while Hobart leads the field on both annual returns and 5-year gains. But the other market that is moving higher is the stock market, despite the miserable global outlook for trade and manufacturing. The US S&P 500 and Nasdaq have just hit fresh record highs, a year out from the US presidential election, and our ASX 200 is defying the bears, also enjoying strong gains in 2019, which seems to have escaped the media's attention. But we now have the strange situation of trade wars hitting growth and forcing central banks to keep cutting rates, with fears of a global recession, but most markets ignoring the economic data and punting that record low rates will do the trick. The US lowered their interest rates as well last month, and their growth rate is now back below 2% like ours. But this US rate cut, plus the promise of more to come next year, has the US dollar under pressure, which may see the end of the trusty downtrend in our Aussie dollar, which did have one more dip last month down to 66 2/3 cents, but that may be it on the downside. As the chart shows, the Aussie dollar is mainly driven by the strength or weakness in the US dollar. So the recent fall in the US may signal a turning point, especially after our better jobs and inflation data. If it is a turning point and our dollar starts to trend above 70 cents, then the RBA may be in the tricky situation of recognising that further rate cuts won't help much, leaving government fiscal stimulus the best option. But if the federal government are firm in their commitment to deliver a surplus, then quantitative easing might be the only option. QE has had mixed success overseas, but does tend to weaken the exchange rate, so might be the best option for the RBA, as rate cuts might be helping some markets, but haven't helped yet with retail sales or consumer confidence. And that's the market update from Bendigo Bank.